Hi, Larry Berman here, and here's what's on my radar this week. Well, as earnings season kicked off in the US, we saw some of the big financials report, and financials are getting trashed today, not on a broad basis, but JP Morgan's, the Citi, the ones that have more of a trading, fully integrated bank, as opposed to the Wells Fargo, which is much more of a bank. So the bank numbers, the interest line lending, those numbers were pretty decent. The trading numbers tended to miss a little bit, and that's where, we're seeing some weakness in a Goldman Sachs type name, Morgan Stanley type name, where some of the regional banks still are doing pretty well today. What also came out today was the retail sales report, and this is where we got just a punch in the gut. So the consumer in December was invisible. When we look at the sort of the year-over-year comparisons and say retail sales on an absolute basis were like this, but inflation was like this. So on a nominal basis, when you say prices were up, sales were up, the consumer, since getting all those checks about a year ago, nada. So prices are going up at a faster rate than incomes are going up. So this is a really big problem for the consumers. At the same time, the political pressure on the Fed to do something about it. So you have all the Fed squawkers coming out, and presidents and the ex-presidents, everyone giving their opinion on what the Fed should or shouldn't do here. The risk of a policy mistake this year is colossal. Powell, in his nomination hearings this week, was again quite masterful in navigating the market and saying, don't worry, folks, we got this. We can smooth this out. Inflation's going to peak soon. We don't have to be that aggressive. So the January 26th Fed meeting is now critical, and it coincides with some of the big tech names reporting, and you know the ones that week. So that's going to potentially be a pinnacle, because if we're going to get a sell the news kind of impact through earnings season, then the markets have made their highs, possibly for the year, and that we're going to spin our wheels and struggle as the Fed unwinds and tightens policy. But for now, earnings are going to be okay, and that should help us. So for the dip buyers, JP Morgan's a name you might want to look at, but the banking story and why you want to buy the banks aren't early. We were buying banks months and months ago, and we've been trimming. On the energy side, another parabolic chart in recent weeks. I don't think it's over yet, but we are getting close to resistance in the mid-80s for WTI and slightly higher for the Brent complex. I see more value in international names than I do in the US names at this point. So, we're tilting the energy exposure that way. Some of the drillers and producers won't ever reach their full valuation potential. So there's a lot of room to move there because of the ESG underinvestment in a lot of those names. So within the sectors, a lot of interesting places to go. But on the broad basis, we're seeing, in a lot of the themes we liked, very overbought readings. That's going to be digesting earnings a lot of the next couple weeks for us. And they should be very interesting when you overlay that with macro and central bank policy. So our bull and bear pick of the week, the bull pick that we put out last week, medical marijuana. The more Biden's presidential ratings weaken, the tougher it is for them to be able to pass any kind of bill in the next few months, although they know they need to do something. So passing banking reform is getting pushed to the back burner. Listen, it's got to come. It makes tremendous sense for that to happen. But we need that as the catalyst in the medical marijuana space. I still think that you want to be nimble, but you want to look at that area as getting very oversold. The other area, we're not there yet, but these high-flying ARC ETF type holdings, a lot of them are getting very, very attractive, and we're digging into the ETFs and we're looking for individual names. Palantir, starting to look very interesting. Teladoc, CRISPR, a lot of these names that we think are going to be great investments for years to come are now coming back into the value areas where we start to get very, very interesting. So RK ETF broke 80, again, keeps breaking support levels. 50 to 60 range, probably compelling from a multi-year buy the dip perspective. We're not there. If you start writing puts on those over the next couple of months, you can earn premium while you wait to buy these things as they get even more oversold. They certainly will continue to get more oversold in the months to come as we debate Fed policy and what long-term value is on a company that currently doesn't have any profits. On the bearish side, those are some of the names to avoid right now. So we're very, very wary of large cap tech in general and market risk overall. Very, very cautious. This is a market where you've got to be selective. I'm loading up on value and low PE names as the way to position if you want to be long equity exposure. Have a great week, everyone.